In this lesson, we're going to be looking at adjusting and closing entries for merchandising businesses. So hopefully this is the end of this kind of section. And as we continue on, of course, we're going to do a quick little review. We obviously have the accounting cycle, and now we look back at this last stage, the order of closing accounts for a service business. Can you tell me what those 4 steps are? I'd encourage you to pause the video at this point and see if you can recall those on your own. Well, now that you've had a chance to think about it, first we close out the revenue count, then we close out the expense counts, then we close income summary to the equity account, and then we close drawings into the owner's equity account, and that sets all these temporary accounts that we need timeframes for to 0. So, give some reasons why physical inventory count may be different than the inventory count. So let's just say a business like Home Depot, they say, okay, we've got an inventory $1.2 million, but then when they go and actually check, they've actually got 1.1. Again, I encourage you to pause at this point and see if you can come up with some ideas based on some ideas from previous students in previous years. This is what they came up with: stealing, miscount, misplaced items, damaged items. So this could explain differences between the inventory number on the books and the actual physical inventory that is counted. And here we lead into these questions for thought. What happens when the physical inventory count doesn't equal the inventory count? And how are the closing entries different for a merchandising business, not service merchandising business, versus a service business? And that's what we hope to address here. So, adjusting and closing entries specifically for a merchandising business. Physical inventory doesn't match. Well, reasons: error occurred when they selling a product or journalizing a transaction, theft. Possibly an adjusting entry is possibly there could have been issues or problems with the books, and these things, the differences, requires an adjusting entry at the end. We debit cost of goods sold and we credit merchandise inventory to try and make sure that it is updated to the correct amount. Essentially what this does is it allows us to expense these goods as though they were sold or lost or damaged in some way, shape, or form, and so they technically count against our revenue. So that's a good thing for us. Bad thing that it's gone, but it happens, right? So here we go. We've got this on December 31st, first example. Lenovo's books shows merchandise inventory valued at $65,500, but when they actually go out and do a physical inventory count, it shows that there's actually $63,300. The difference between the two is $2,200. Pause the video at this point and see if you can figure out what the adjusting entry will be. Now that you've had a chance, let's go ahead and take a look. First of all, we're going to have cost of goods sold, which is going to be debited just like we saw in the last one, and the amount is the difference between these. And we're trying to decrease the inventory amount by that $2,200, so it is credited, and this is what we've got. So this is our adjusting entry. So cost of goods sold $2,200, merchandising credited $2,200, and we have this little note at the bottom to record inventory difference from a physical count. And regardless of whether we're doing periodic or perpetual systems, there's always some sort of physical count at least once a year. So closing entries order. In fact, it'll be pretty darn similar to what you already saw with the service businesses. Temporary accounts with credit balances are closed to the income summary. Temporary accounts with debit balances are closed to the income summary. Income summary gets closed to the capital balance, and then drawings gets closed to the capital balance. So let's go take a look at an example. We want to journalize the closing entries based upon this trial balance below. So what exactly are we doing? Well, these accounts from cash all the way down to capital are either assets, liabilities, or owner's equity accounts. And anything else from drawings down is what we really care about closing, because these are based upon time. So let's take a closer look. These are the accounts that we're going to be closing. I'd encourage you to pause and see if you can figure out what those closing entries are going to be. Try it on your own. This is relatively similar to what we've learned in the first unit. Now that you've had a chance, we're going to close out all those revenue balances. So we've got our sales, which is debited, and our income summary gets credited. And whatever the normal balance is, so we normally consider sales to be on the credit side, we want to set it to 0, so we end up debiting it. We're doing the opposite of the normal balances to get rid of them. And then down below, we're going to have all the expenses along with the other cost of goods sold, as well as our salaries, returns, and allowances. So after we add up all of these things here, it ends up giving us $450,000. All right, and that means that we've closed it out. Now, is this going to be a income gain or loss? Well, we can just take a look at these main numbers here. Right now, we've got an income summary. The 480 is larger than the 450, so this is in fact a net income, and that means that right now, income summary has a difference. If we're to take 480 and 450, right now it's got a balance of 30,000 on the credit side. So in order to get rid of it or set it back to 0, we need to debit it for 30,000, and that means that we're going to be putting up our credit account, or sorry, our owner's equity account up by 30,000. And our final entry for this is to close out the drawings. There's our 15,000, and that is it. Again, quick little lesson. If you got any questions, always come back, ask me, and see you in the next one.